Welcome back. So, we're diving straight into one of the most mind-bending paradoxes in the market right now. Palantir Technologies, the absolute powerhouse in data analytics and AI. Well, they just delivered a flawless quarter. I mean, they beat earnings, they raised guidance, their execution was literally top tier. And yet, the stock price just took a massive nosedive. We're gonna pop the hood on this one and unpack exactly what's going on, looking at how soaring operational metrics basically crashed headfirst into Wall Street's completely unforgiving expectations. So here's the million-dollar mystery we're trying to solve today. How on earth does a company report its best quarter ever, only to watch its stock absolutely crash? It's kind of wild, right? That's the cognitive dissonance we're dealing with here. Investors are scratching their heads, because usually you see a beat and raise quarter, you expect a massive rally. But no, Palantir shares slid 7% right out the gate, kicking off an even broader downward trend. To figure out the why, we really need to look closely at what the numbers are whispering to us, and honestly, what the market was already baking into the price. Okay, let's start with the momentum, because it is staggering. 85%. That's Palantir's year-over-year revenue growth in Q1 2026, hitting a massive $1.63 billion. Listen, for a company of this size, accelerating top-line revenue to 85%, that's not just good, it's exceptional. We are talking about a software company operating on absolute steroids here. This isn't just your standard steady growth. This is explosive, elite-level acceleration that most enterprise companies literally just dream about. Now, if we follow the money to see exactly where this cash is coming from, Palantir is basically a tale of two core segments. Looking at the breakdown leading into this year, the US government still accounts for a massive 41.2% of the revenue. They're the absolute bedrock. Then you've got international, sitting at 25.4%. But the real star of the show, sitting at 33.6% and growing like crazy, is the US commercial segment. This is their enterprise side, and let me tell you, it is completely reshaping Palantir's entire future. Get this, US commercial revenue skyrocketed 133% year over year. That is triple-digit growth. And it's being driven almost entirely by the explosive, insatiable demand for their artificial intelligence platform, or AIP for short. What this actually proves is that there is massive, real-world appetite for their AI in the corporate space. We're not just talking about shiny tech hype anymore, we're talking about real companies deploying Palantir software right now to run their daily operations. And what's fueling this crazy demand? Well, it's their totally unique go-to-market strategy. Palantir isn't selling software the old, boring way. They use what they call the AIP Bootcamp. It's basically a three-step playbook. Step 1, they deploy the platform directly onto a client's actual, messy data, not some sterile, generic sandbox. Step 2, within a matter of days, they show immediate, tangible return on investment. And Step 3, rapid conversion. They're completely bypassing those agonizing months-long software pilots, and they're turning skeptical C-suite executives directly into paying customers at warp speed. But here comes the brutal reality check. Despite printing a staggering 60% adjusted operating margin and even raising their full-year guidance to $7.65 billion, Palantir stock suffered a severe 30% drawdown from the highs it set back in November 2025. I mean, it's down roughly 20% in 2026 alone. So you have to ask yourself, if the business is hitting absolute home runs, why the massive sell-off? Well, the answer lies in exactly how the market values perfection. Which brings us to the first big reality check. Extreme valuation multiples. You see, when a company executes flawlessly, Wall Street naturally bids up the price. But sometimes, their price tag gets dangerously heavy. Palantir's forward price to sales multiple is sitting at a jaw-dropping 42x. Let's compare that to the industry median, which is just 12x. To really put that into perspective, Microsoft trades at roughly 10 to 12 times sales. So Palantir is priced at a massive, massive premium. You are paying top dollar for every single cent of revenue. And the thing is, when a stock is priced for absolute flawless perfection, any tiny perceived crack, or honestly, even just a lack of new mind-blowing surprises, can trigger a huge sell-off. Now, to be fair, there is a very strong bullish argument here. Dan Ives over at Wedbush has literally called this a golden path toward a $1 trillion market capitalization within 2 to 3 years. If you look at it from that angle, Palantir isn't just another software vendor. They're the preeminent AI operating system of the Western world. If you genuinely believe they're going to be the indispensable bridge between massive data silos and actual intelligence for the entire corporate world, well then maybe that crazy premium valuation makes total sense. Flip side time, we absolutely have to acknowledge the bearish warnings. Famed investor Michael Burry pointed out something fascinating. Palantir's market cap currently puts it in the exact same weight class as legacy defense giants like Lockheed Martin and Raytheon combined. Let that sink in for a second. We're talking about companies with decades of proven ironclad cash flows. So the skeptics are arguing, hey, valuing a software company, even an amazing one, like an entrenched military industrial titan, that's just a recipe for a brutal price correction. This underlying tension becomes crystal clear the second you run traditional financial models, like a discounted cash flow analysis. The results are pretty stark. Models from places like Simply Wall Street and AlphaSpread estimate a fair value for Palantir's underlying cash flows to be somewhere between $20 and $27.54 per share. Compare that to the stock trading in the $133 to $178 range recently. These fundamental models are basically flashing giant red lights, flagging the stock as potentially overvalued by up to 89%. Sure, DCF models rely heavily on assumptions, and yeah, hypergrowth AI companies notoriously break those models, but it really highlights just how much premium is currently baked right into that stock price. So let's look for the hidden cracks. Let's talk about the forward-looking red flags. Moving past just the valuation debate, we really need to look at the specific underlying metrics that actually spooked investors during this latest earnings call. The big one, total contract value, or TCV. So TCV is the total potential lifetime value of contracts entered into with customers at the exact time they're signed. Think of it essentially as the company's backlog. It doesn't tell us what revenue was recognized today, it tells us exactly what the sales pipeline looks like for tomorrow. For any hypergrowth company, your TCV is basically your crystal ball. And here's what that crystal ball showed, which caused the broader market to violently hit the brakes. While current revenue was up an amazing 85%, the total contract value growth actually saw a really sharp deceleration. Check this out. In Q4, TCV grew by an unbelievable 138%, but in Q1, it grew by 61%. Now, don't get me wrong, 61% is still fantastic, but it's a massive sudden drop from the previous quarter. Even the US commercial slice of that TCV cooled off, dropping from 67% growth in Q4 down to 45% in Q1. This proves numerically that the underlying sales momentum, the actual pipeline of future dollars, is cooling. And honestly, that's a huge red flag if your stock is priced for endless exponential acceleration. Then you add the technical picture into the mix. Analysts and trading algorithms recently flagged a death cross. Sounds scary, right? It's basically an active bearish technical trend, where short-term moving averages drop below long-term ones. Now, while fundamentals dictate the long game, this technical signal created a lot of short-term anxiety. It prompted technical investors to basically step back, hold their cash, and wait for a lower entry point, which definitely added fuel to that post-earnings slide. Looking to the road ahead, the macro and competitive risks from 2026 to 2028. First up, the hyperscaler threat. Because Palantir doesn't operate in a vacuum. They are staring down intense, heavily funded competition from tech behemoths. Microsoft with Azure AI, Amazon's AWS SageMaker, Google Cloud AI. These hyperscalers have practically bottomless R&D budgets. But more importantly, they already own the enterprise relationships. They have the power to just bundle similar AI tools straight into their existing cloud packages at very, very attractive prices. That is a real tangible threat to Palantir's pricing power and their whole market differentiation. Plus, Palantir is walking a very tricky geopolitical and macroeconomic tightrope right now. Remember how over 40% of their revenue is tied directly to the US government? Well, that exposes them completely to shifting political winds. On one side, you've got reports of proposed Pentagon budget reductions of around 8% annually, which would severely squeeze their revenue. But on the flip side, you have proposals like Donald Trump's $1.5 trillion defense budget, which would be a massive tailwind for them. Now, we aren't taking any political sides here whatsoever. We're just pointing out a mathematical reality. Palantir's cash flow relies heavily on these super unpredictable, almost binary government budgeting decisions. Finally, we can't ignore the law of large numbers. As Palantir scales its revenue base from $4.4 billion to $7.6 billion and beyond, mathematically speaking, sustaining hypergrowth gets incredibly, painfully difficult. The current projections show growth decelerating from 53% in 2025 down to somewhere between 25 and 30% by 2027. And here's the kicker. If that deceleration happens even a fraction faster than Wall Street anticipates, the momentum-driven premium keeping that stock price afloat, it could evaporate in a heartbeat. So to wrap this all up, elite business or unforgiving price? The operational excellence of Palantir is absolutely undeniable. They are crushing it. But The market has already priced in years and years of absolute perfection, which leaves us with the ultimate question, and it's one you have to weigh for yourself. Is Palantir genuinely a generational AI operating system that's going to dominate the corporate world, making today's price look ridiculously cheap 10 years from now? Or is it a story stock, priced for an impossible level of perfection, with slowing contract growth and aggressive competitors waiting in the wings to drag it right back down to earth?
Before we officially sign off, just a quick reminder for everyone. This explainer is strictly for educational purposes. Investing always involves the risk of capital loss. So please, always do your own thorough research before investing your hard-earned money in any company. Thanks so much for hanging out and unpacking these numbers with me today. I'll catch you in the next one.